Well, welcome everyone to the CCIM Investment Analysis Comparison and Portfolio Modeling. This is my own presentation, but we are a member advantage partner with the CCIM Institute. Have been a member advantage partner with CCIM for many, many years, and very grateful for doing so and all of their support, ongoing support. We're going to talk about a little bit about comparison and portfolio modeling when doing an investment analysis, a discounted cash flow or DCF analysis, to try to analyze, take your analysis, let's say, one step further. And you might recognize a couple of these pictures on your screen. We're going to compare a couple different properties and actually do a full case study on this today. For those of you who don't know me, I'm Todd Kuhlmann. I have been in commercial real estate for 31 years now. I can't believe I can say that. I ran a commercial and founded a commercial real estate finance company and did that for 14 years, lending over $1 billion in commercial real estate. Received my CCIM designation in 1999, very proud of that, and also became a CCIM 101 and 104 instructor, which I'm excited to be back in classroom teaching. Just taught 104 in Raleigh a couple weeks ago, and just so much energy and so exciting to get back in front of you, in front of the class. I actually went to work for the CCIM Institute and the CCIM Tech, teaching people how to do investment analysis, how to go in and run demographic analysis. And that was really what led to me creating and starting CRE Tech and finding TheAnalyst PRO, building TheAnalyst PRO over 11 years now. We have evolved TheAnalyst PRO and continue to do so, especially with this new enhancement we have with the comparative and portfolio analysis. And let me tell you real quick too, when I was going around the country, I went to 52 different chapters around the United States, presenting demographic analysis, financial analysis, lease analysis. And time again, commercial real estate practitioners, CCIMs like yourself would come to me and say, I'm not going to use this. I was like, why are you not going to use some of these platforms? So it's too complicated and I don't want to make my life more complicated than it already is. So I took that feedback, and that's when I started CRE Tech and created TheAnalyst PRO with the premise of saying, okay, we want robust, we want heavy duty analysis, but we need to make it simple or people are not going to use it. And I'm going to show you today just how simple you can go in and do a comparison and a portfolio report. But we really go to that Argus level of underwriting and analysis, but keep it very, very simple. So that's kind of a quick background on us and how we got started and why and the niche that we have created for ourselves. Want to give a shout out to all of our national relationships, CCIM right there at the top. Again, without these relationships and without our subscribers, we would not be here. So we're very thankful for that. Before I get into the portfolio and comparison reports, I also want to let everybody know that we kind of quietly rolled out a new KPI report in the investment analysis. So if you're currently using the investment analysis, yeah, we don't need you, go away, big sir. All right, we'll have to go over there. I don't know why I have to have a software update right in the middle of a recorded presentation, but hey, why not? Okay, bring back PowerPoint. Sorry, everybody, I'm sure this is not the first time it's happened. Okay, so we kind of quietly rolled out our equity multiple KPI report that's in the investment analysis tool. And I'll show you as I'm going through and entering how you would get to this. Coming in the equity multiple, and I really became a fan of this. I've had some of our clients request this, using it for different institutional type investors that use equity multiple. But being a financial analysis person, having to teach IRR and cash flow analysis, and use it myself in our own investments, I've come to like the simplicity of this new, well, I won't call it new, equity multiple's been around, but we introduced it new into TheAnalyst PRO. But I really like the simplicity of being able to explain and describe equity multiple to a client. Basically, coming in, and if you invest in a property, it's at what point do I get my money back? So your money coming back from your initial investment, from any equity you injected into the property, that would be your down payment or any cost associated with buying the property. When would I get that back? At what period? And then if I hold this property 2 years, 3 years, 4 years, 5 years, what multiple on my equity do I receive? So to see if I got my money's back, I would basically have a 1x multiple, equity multiple. And if I had, in this case, you see, I did an analysis, say if I owned this property for 5 years, I would have a 2.03 or a 2 times equity multiple, meaning over that 5-year period, if I sell the property at the end of the 5 years, I've doubled my money. What easier way to explain to a client than that, in my opinion? So you can get into the IRRs and the cap rates and the cash on cashes, but I really like this equity multiple coming in, just saying, hey, if you own this property for 5 years, I'm analyzing this, it looks like you'll double your money. Where else can you do that? So I guess somebody would say Bitcoin, but I'm not into the cyber currency just yet. All right, so moving on into our comparison and portfolio analysis, why all of you are here. We have added the ability to basically combine up to 10 properties that you put in the Analyst Pro into one comparison report, as well as a portfolio report. So now you can compare these properties side by side. Why and when and why would you want to compare properties? I think this may be kind of a silly question, but I also want to kind of expand what you may be thinking on when and why. Obviously, coming in and representing a client that may want to buy commercial real estate investment property, that's obvious. Okay, now I can combine, several different properties that we're looking at, that we're considering side by side. I can compare the cap rates on those properties, the cash on cash return each year, the IRR, and I call it the equity yield. And equity yield would apply when you finance the property. So I can do all of these different things on a comparison report when I acquire the property. Also to compare what my equity investment from property A to property B to property C would be as well. How much cash do they need to come out of their pocket with to buy each of those properties? And again, we make the report nice and graphical, so it's easy to explain, easy to present to a client. And as you'll see here in a few minutes, something that will appear to your client to take quite some time to put together, but in reality, it's very quick and very easy. But I want to go beyond just the acquisition phase here a little bit and talk about some other when and whys you may want to run a comparison report. During the ownership phase, while you own the property, and for those of you out there that represent buyers of properties, this is a great method for you to get in front of that client, stay in front of that client and say, hey, I want to reanalyze your property every year. I will for free come in and reanalyze your property every year. And you can use this as kind of some decision making during the ownership phase as well. During the ownership phase, what are some of the decisions you make? Well, do I lease to this tenant? Do I do concessions for this tenant? What kind of market rate do I go up on my rents? How much do I go up on my rents? All of these factors really come in and change the value and the cash flow of the property over a period of time. So when you're going in and saying, well, if I do this concession today, what is that going to mean in the future? Or if I do this lease today, what's that going to mean in the future for the value and the cash flow of my property? And this is a way to kind of come in and say, okay, here is scenario A. I'm going to lease to this company at this rate with these concessions. In scenario B, I take this lease and compare it in side by side. And then I can see, hey, what does this do to my IRR? What does this do to my equity return over 5-10-year period? Also, you look at maybe discretionary capital expenditures. What's a discretionary capital expenditure? Well, just as it says, it's discretionary. You can do it, you cannot do it. It's not like a leaky roof. A leaky roof is not discretionary. You have to do that. You have to do that capital expenditure. But maybe you're going to do an enhancement on the property. Maybe you're going to remodel the property. Maybe you're going to add on to the property. You can compare the property today and side-by-side comparison. What if you do that capital expenditure and increase the rents? What is that going to do to the value of my property, my cash flow, my IRR in the future as well? And then also during the ownership phase, you can make decisions. Should I sell today and buy something else? Again, you could compare them side by side. Should I refinance the property? Maybe refinance and cash out. How does that change my short-term, long-term cash flows? So you could model the property that you have today with the current financing in place you have today, and then side by side come in and say, hey, we're going to refinance this, and we're going to put this on new loan, we're going to cash out, all these different options. And then finally, the disposition phase. You can compare different property alternatives, different market alternatives out there. So you can say, well, what if I kept this property today, or I sell it and buy a different property? So these are the different decisions and times you can run a comparison report that maybe a lot of you and myself didn't really think about, that different ways to use this. And again, if you're out there trying to make a difference, trying to stand out from the competition with your clients, a great thing to do is come in and say, hey, I know you own that property right now. And instead of, and let me tell you, people call me all the time and say, Todd, I've got a buyer for your property. And real estate brokers are calling me all the time. Todd, I got a buyer for your property. It's like, great. I'm not in the mood to sell right now. If I sell that property, I've got a problem. What am I going to do with this cash? Where am I going to go with it? Coming in here, having this comparison report, you can not just say, hey, I got a buyer for your property, but you can say, hey, let me come in, analyze your property, compare it to some other alternatives out in the marketplace, and see if you can get a better bang for your dollar, better return on your investment. And that way you're adding value, you're doing a value proposition for that lead and potential customer, as opposed to just coming in and say, I got a buyer for your property, which is way overdone today. All right, so those are some ways to use that comparison report. We'll build a comparison report in just a few minutes, but I want to talk also about the portfolio report. So we came in and said, okay, if I've already got my properties in the Analyst Pro, I've already analyzed individual property scenarios. Now I can come in and say, hey, let's take those properties and mash them, compare them, or mash them together and put it into a portfolio report. Portfolio report, we can go up to 10 properties in it as well. Well, when and why would I do a portfolio report? And again, we come to the obvious on the acquisition phase. So coming in on the acquisition phase, you want to combine multiple properties together. And we blend the cash flow from all those properties then at that time. So if you got a client that says, well, I really need a 14% return on my money annually, and they've got $1 million to invest, you may say, well, hey, I can buy this property, it's got 18%. I can buy this property, it's got a 14% return. But if I combine the two, I'll have a blended return that meets or exceeds their current, and you're taking all of their cash flow, all of their equity, and investing in it and diversifying as well. So a lot of times when you're working with a client and they might say, hey, I've got so much equity to invest, you don't have to go out there and say, okay, I'm going to find just the properties that I can maximize that equity with. You may say, hey, well, what if we bought 2 or 3 properties and diversified with that equity? So again, on the acquisition phase, which is a little bit more apparent, obviously. But what about the ownership phase? Well, I'm going to go back to what I was saying before. This is a great time during the ownership phase to go in and analyze somebody's portfolio properties. So if you're out there hitting the streets, marketing, and you find a client's got 3 or 4 properties, now you can say, hey, I could come in and analyze your entire portfolio and give you an idea of what your portfolio is worth today, not just maybe a comparative market analysis or CMA on one property, but now you're coming in and saying, hey, I'm going to go in and analyze all 8 of your properties and see what that portfolio value is today. You can refine your forecasting. So again, coming in, and I'm telling people to do a portfolio analysis at least annually. The big asset managers out there that are managing these huge funds of REITs and pension funds and life insurance companies, they're actually analyzing and doing the portfolio report on a monthly basis. They want to know what the trends are. They want to refine their forecasting. They're doing this on a monthly basis. And of course, when a tenant changes, they're doing the same thing. So when they have a lease change or a new tenant coming in, or a vacancy, they're analyzing that. They're refining all that forecasting. This is something that you can provide to your clients as a service as well, whether you charge to consult with the clients and come in and analyze that like asset managers do, or whether you're coming in and doing it as a service to build that long-term valued relationship that says, okay, I just sold you these 3 properties. Let's schedule a time next year, same time next year. I'll come in, I'll reanalyze this. We'll look at the value of your portfolio a year from now and see if there's any key decisions that I can help you with at that time. And then finally, the disposition phase. Obviously, you want to be able to value that group of properties, that portfolio of properties, to determine what that overall portfolio is worth, and then come in and use that to help identify any investment alternatives as well. Lori, Raina, any questions that came in? I haven't spent any time looking at that chat box. If not, I'll get into working on our case study. Nothing? All right. You're quiet.
Nothing right now.
All right. Thanks, Raina. Okay. So for those of you that have taken the CCIM 101, and I pulled out my wonderful CCIM 101 book here, nice 300 and some pages of text. There's two case studies that we do in the CCIM 101. One case study is called the Plaza Suites office complex, and the other case study is the Summit Apartments. And in the one, if you haven't taken the 101, it's amazing. But what we do is we have literally coming in 32 hours we spend with these two case studies. The Plaza Suites is a sample that I use to show the students, hey, this is what you're going to do now with, and a lot of times by hand, on the Summit apartment complex. But over a 4-day period, over 32 hours, we analyze both the Plaza and the Summit apartments, and then we compare them. And we compare them side by side. And right at the end, last day, we've done all the numbers. We compare them side by side and say, which property would you want to buy, or would you recommend? I thought, well, hey, this is a CCIM sponsored presentation. I'm going to take the case studies right out of the 101, and we're going to do those and analyze them today. We're just not going to do it in 32 hours. I'm going to do it in about 15 minutes with the Analyst Pro, obviously. So for those of you it's been a while since you've taken a 101, or for those of you that haven't taken a 101 yet, and I say yet because hopefully you will, I'm going to give a quick overview of each of these properties. So the Plaza Suites, and I apologize, I did screenshots out of the CCIM book on this, but the Plaza Suites purchase price $3,750,000, acquisition cost $80,000, year one income $480,000, and it's going to grow at 2.5%, 10% vacancy. Our year one operating expenses $165,000. Looks like somebody forgot an O on there. And operating expense will grow at 3% a year. When we're ready to sell the property, and in CCIM 101 and 104, we always keep the properties for 5 years. We can analyze it and analyst up to 10 years, but just keeping with the CCIM case study, we'll do a 5-year analysis today. But we'll cap the NOI at 7.5% to determine the sales price we'll sell this for at the end of year 5. And our cost to sell at the end is going to be 3%. Over here on the other side is our financing, 75% LTV, 3.75% interest rate, 25-year and 5-year balloon on that note. Loan cost 2% of the loan amount. All right, so I know that was a mouthful, but I did want you to see where I'm getting the numbers that I'm going to put into the Analyst Pro. So I'm going to start putting numbers in, and you're like, where did you get those numbers? Well, it came with the case study setup in the CCIM book 101. And then the Summit Apartments, this is the one we actually have the students do by hand in many cases, coming in and calculating the cash flow analysis on the Summit Apartments. Summit Apartments, $4.6 million with an acquisition cap rate of 5.72%. It's a stunning 25-unit apartment complex, all 2-bedroom, 2-bathroom apartments in the project. And now we get into some of the nuts and bolts. 4.6 million purchase, 120,000 acquisition cost. Coming over to the other side, you see some of the financing assumptions on this as well. And then each of the units was renting at $1,500 a month. That's in some other setup sections. All right, so what's my first step? I'm going to log into the Analyst Pro. And in the Analyst Pro, we have literally 20 different tools in our platform. Great calculator tools. We got a tool for almost any occasion in commercial real estate. A lot of marketing tools, which if I have a few minutes at the end, I'll show you some of the great marketing tools that we have. But obviously today's session, we're going to be focused on investment analysis, DCF analysis, modeling investment properties. So I'm going to go into my analysis reports and select my investment analysis. And you'll see, if you're a longtime user of the TheAnalyst PRO, we haven't changed anything, we've just added. So now we go in and create your analysis just like you always have, but now we've added this new section called Comparison Portfolio in there as well. So let me flip over live into my dashboard at the TheAnalyst PRO. So I'm logged in under my CCIM account, and I'm going to come in here, and this is where we keep all the different tools up here. So I got my analysis reports, my property reports, my calculators, and my maps and tools. I'm going to select on analysis reports. And here you can see we've got comparative lease, lease versus own, loan amount. I'm going to come over here to investment analysis. By the way, this is one of our most used tools by our subscribers up here, is the investment analysis tool. And very robust as well. Like I said, almost Argus-esque robustness. So the first thing I'm going to do is I got to set up the Plaza Suites, and I've got to set up the Summit. So I'm going to set those up separately and then come over and run the comparison on portfolio. So when you're doing this, you'll need to put each of the properties into the TheAnalyst PRO that you want to put into your comparison or portfolio analysis. So I'm going to start here with Plaza Suites, and I'm going to save this in my CCIM 101 the demo folder. I'm going to create a new folder and go through and enter and create this property analysis. And if you see the way we've set this up, I'm just going to go step by step: property information, income, vacancy expenses, mortgage, disposition, and then of course build my report. So on the Plaza Suites, that one was the 3.75 million, 3,750,000 purchase price. CCIM doesn't have an address for that, so I'm going to leave that blank. And didn't have a square footage, but I came up with $200 a square foot. So I came up and said, this is going to be 18,750 square feet. There we go. And we'll just say we're going to purchase it this month. I'll click next. That saves that information. I get a nice little checkbox to go on now to my income information. The way they set this up, they said the potential rental income on Plaza was $480,000, and it was going to go up 2.5% per year. Now, obviously, this is a pretty simple case study. Some of your real world scenarios, obviously you have a multi-tenant office project. You probably want to enter each lease individually. You can do that here by adding lease details, and it actually creates a rent roll for you. You can put in custom escalations based on that lease and that lease analysis. So you can take this really to the next level, or you can keep it simple. Anything with an asterisk is a required field. So I just entered the income and income increase. There is no other income on Plaza, so I'm going to say 0 there, and I can keep the other income increase at 3% because 3 times 0 is still 0. Click the next button, and now I'm done with the income side. I get a nice little checkbox over here. This, we did say we're going to analyze this at a, let me get my cheat sheet out here, 10% vacancy factor. And my operating expenses was $165,000. Going up at 3% per year. So we default that 3. If I want to enter, again, real world, you probably say, hey, I got property taxes, property insurance, property management. You can enter each individual expense. The case study in CCIM just gave me the total expenses on this property. Click on the continue button, and now my vacancy expenses are done. Now I enter the mortgage information. My loan amount on this was $2,812,000. And my rate is 3.5, 20-year AM, and 10-year term. They were charging 2% for loan fees. And now I can click continue. By the way, I just wanted to point out here, if you did want to consider a refinance scenario, maybe you're doing a comparison side by side, like I said before, of, hey, keep this loan on it, or, hey, let's compare this side by side with, maybe I'll do a refinance cash out in 2 years. How does that change my numbers over a 5-10-year period? So you can get pretty fun with the comparison on just the same property on different scenarios.
Hey, Todd.
Yeah.
I'm sorry to interrupt, but really quickly, it says, what if I'm analyzing large portfolio of SFRs?
So single family residences, which is big investment category now, obviously. So number one, we max out at 10 properties on the comparison or the portfolio. So my recommendation, if you're dealing with single family residences, is go in there and maybe build them in one analysis and say, almost treat it like an apartment complex, if you will, where I can come in and I'm going to put an apartment in next. So I'll show you how you could treat this as an apartment, but let's just say you have 100 single family residences. Instead of entering 100 different properties, I would go in there and just say, I have 100 units. And then you could go in and break down the unit types and the rental rates and things like that and put each individual house in there. And I'll show, that's a great question. This is really popular right now. So when I do Summit apartments, I'll show you how I would recommend doing the SFRs. Thanks, Raina. That was perfect. All right. Now I want to enter my default setting. So I've entered all the information over here. I'm time to build my report, but I do need to go into my default settings and put in my acquisition and disposition cost in here. We're doing a before tax analysis, so I'm okay on the taxes, but they did say on this it was going to be $80,000 in acquisition cost. You'll see up here it's a percentage or a dollar amount. You got this little I icon. Any number between 1 and 99 is a percentage. I wouldn't want 99% of my deal to be acquisition cost, but this is just how I programmed it. Any entry of 100 or greater, we assume is going to be a dollar amount. So when I put 80,000 in there, we know it's going to be a dollar amount. And then vice versa, we're going to say 3% cost of sale at the end of this. So I'll put in my 3%. And that's all I need to change here in my default settings. Default settings also have tax settings in here, but our analysis today is all going to be before tax. All right, saved. And now I can run the report. Now, if I want to, I can go over and do the comparison, but maybe I want a detailed report for just this property. I can do that right now. So I could come in, and this is where we added that equity multiple that I was talking about a little bit before. But let me just come in real quick, and you can see all the different sensitivity analysis and KPIs that we can add to this. But I'm just going to generate that particular report real quick so you can see what the full Plaza would be, and then we'll come over and do the same with the Summit apartment complex. I'll do it a little bit faster since I've kind of talked about how it enters, and then we'll spend the rest of our time really looking at the comparison and portfolio reports as well. Antonio, great. Thank you. You're welcome. And like I said, when we get to the summit, I'll try to talk a little bit more about that. Anyone have these questions, please chat in the chat box. Great questions, and this is perfect time to ask. All right, so now we built this 5-year cash flow analysis. We get our IRRs, we got our cap rate, cash on cash, gross rent multiplier, all of these great key metrics on the property, but we're not comparing it yet, right? So this is a standalone investment analysis report that I've run on the property. I love graphs, so you see my cash on cash, that equity multiple I talked about before. In this case, we'd have to own what this is showing me. I'd have to own the Plaza for at least 2 years just to get my money back. I wouldn't get my money back if I sold it at the end of the first year, but if I hold it for 5 years, I get 1.85 or 185% return on my equity over that 5-year period. I think that's cool metrics. Optimal holding period by equity IRR. This is again my annual return I'd have on that property from an IRR perspective, and that's with financing. And then one of my favorite graphs, the impact of leverage analysis. I love positive leverage. If you remember CCIM, we talked a lot about positive leverage. This is really pretty impactful graph. If I paid cash for Plaza, my 5-year IRR on the property is 7.34%. But because of such inexpensive financing right now, I'm able to get my equity return up to 14.47%. This graph right there, I think, is just so impactful for a client to see, why you would want to finance and why these low interest rates make such a big difference. So here I put a 6-page report together on Plaza in just a few minutes. I'm going to come back and I'm going to say, let's open analysis, which takes me back to my investment analysis. You'll see down here under my saved analysis, I've got Plaza Suites saved, but now I'm going to do the Summit Apartments. I'm going to save it in the same folder, my CCIM 101 demo. create new investment analysis. And now I'll pull out my little Summit Apartments cheat sheet. Purchase price on Summit was $4,600,000. And property size in this case is 25 units. So going back, Antonio, a little bit about your SFRs. I'm going to put in 25 here as property size and then do the drop down in units. This would be where I'd put in your single family houses. This will allow me in the next step to build a unit matrix, So if I did the square footage, office, retail, industrial properties, I'd want to do square footage. I can then enter each individual tenant and then have a rent roll created on apartments, mobile home parks, self-storage, anything that's really rented by unit. I would come in and select units, and then I could build my unit matrix from there. So it changes the next step in here where it says, instead of adding lease details, it says add a unit matrix. Well, I know this property has 25 2-bedroom, 2-bath units. If it had 12 1-bedroom, 1-bath, I'd put 12 here and I put 1-bedroom, 1-bath under the unit description. In this case, I have 25 units are all the same size or same type. And I can add as many rows as I want. So Antonio, going back to your SFRs, I would put in, I got 1 unit. You can even put the house address under unit description. If you want it, you could put that house size, and then you could put that monthly rent in there for that particular house. And then you could just start adding all your houses here. So then that would really create a really nice report for you outlining basically your portfolio of single family houses. I'm going to say this is 1,200 square feet and it's rented for $1,500 a month. And there's no limit to the number of rows that I can put in here for this unit matrix as well. If you're doing self-storage, you could come in and say, well, I got, 50 10 by 10s. I got, 20 by 10s or something of that nature. So very flexible in here. Now, this did have other income. We did have some parking income coming in for each of the parking spaces, and it was $16,200, and it was going up at 2% per year. By the way, our annual rents are on the apartments is going up at 3% per year. I skipped over that. Our system defaults at that, but that's where that you could enter that increase. Continue. Page here. Vacancy credit loss was 6%. Operating expenses, they says 40% of gross operating income. So they didn't itemize out the operating expenses. They're just saying 40% of the income I receive on the property is going to go toward expenses. Again, I could go in and line itemize those if I want it. Antonio, on the expense side, you would need to enter the expenses for the entire portfolio of single family residences. You wouldn't enter the expense on each individual house. You would have to combine those, add those up, and then put those in here. Our 75% LTV at 3.75% rate, amortized for 25 years, 5-year term, and 2% loan fees and cost. Press continue button. I'm going to sell this at a 6 cap. And finally, I do want to go into my default settings, and my acquisition cost on this was $120,000. Disposition cost again was 3%. So I'll keep that the same. If I was doing a after-tax analysis, I'd want to change this depreciation life to residential because this is an apartment complex and the depreciation on an apartment is 27.5 years versus a commercial at 39 years. And again, I'd come in and run this report, run my key KPIs in this report. So I've got my 5-year before tax analysis on this. And I'm basically done doing inputs on this. Let's see. How do you pull unit matrix? Kate, let me try to take a jab at that. The unit matrix, basically, I'm coming in and saying how many 1-bedrooms, how many 2-bedrooms, how many 3-bedrooms that I have in there. Why different terms on loans? Good question, Jeff. And this is a case study set up by CCIM. But I will tell you, when you are financing properties, the location and the property type will impact the terms you get on your financing. So a loan quote we would have on an office or retail center was always different than a loan quote we'd have on a apartment complex. And it goes to that lender-specific risk tolerance. We loved apartment complexes. We would lend more, we would lend cheaper on apartments than retail. So hopefully that answers your question. Where was button to add the unit matrix? Oh, okay. I'll come back to that, Kate. Let me kind of go through this report. I just want to show this real quickly. Again, we'll put these side by side in just a minute, but this does the full 5-year cash flow analysis, what we can sell the property for at the end of that 5 years. This is where our unit matrix lives. Now, I only have one line item, but obviously, Antonio, you would have all your houses listed here with your description. The size of that house, the rent, I think it would look fantastic showing a report like this with all those houses, single family residences on there. Big asset class now, and one of the most thriving asset classes now, Antonio, that you're in. So just kind of going through, showing the optimal holding period for the property, impact of leverage. Again, you know, if I bought a Summit with cash versus finance it, cash, I would have a 6.68% annual return, IRR. If I finance it using positive leverage, I'm at 11.91 now. Now, all right, let's go to where we are going to create a comparison between the Summit and the Plaza. And that's where I come over here. So I've entered the properties over here. By the way, if you wanted to take the same property and analyze different scenarios with that property, you could come over here and say, okay, I've entered Plaza. Let's duplicate that, change the name to scenario B, and modify it. So you don't have to re-enter all your information, your rent rolls, whatever. You could just go in, duplicate it all, and then rerun a different scenario. Maybe you want to do a cash out refinance scenario or something like that. Put those side by side. All right, so I'm going to do CCIM 101 compare, and I'm going to say combine. I don't know if I could use an and there. And I'm going to save this in a new folder called CCIM demo. Now, all I have to do to create a comparison report is come in and select the properties that I want to compare. So I've entered the Summit and I've entered the Plaza. I want to compare those two side by side. And note, I can compare an apartment complex to a commercial property. I'm going to do this on purpose. So one's by units, one's by square foot. Our system can handle it. No big deal. And now I can say what kind of comparison report do I want? A 5-year, 10-year, or an optimal holding period? We're going to do a 5-year comparison. I'm going to come back and do the portfolio. So you see I have a little radio button here that switches between the two. I don't have to change any of my inputs to do a comparison in portfolio right now, and just hit on that compare report. Now this one takes a couple seconds, probably about 30 seconds to build, because what I'm doing is the system is analyzing 2 properties and combining the 2 properties. If I had 10 properties, it could take up to 60 seconds to create this report, because again, it's doing a full cash flow analysis on each of those properties. Let's see, thanks. Any questions out there, Marina? Like
I do have a few.
Okay, let's try to hit them while this is processing.
All right, so let me back up here. Why different terms on loans?
I did answer that one and went into.
Oh, you did? Okay.
The different types of properties often warrant different loans. Let me come back because I want to show this real quick.
Sure, go ahead.
We'll answer a lot more questions while I'm waiting on the comparison or the portfolio report. All right, so here's what we did. We took all of the Summit and all the Plaza information. I've got my equity investment, so my initial investment. Let me make this a little bit bigger. So I got my initial investment here. I can see those side by side that I would need $1,339,000 to buy Summit versus $1,074,000 to buy Plaza. I can see the debt service on the property, my acquisition cap rates, my year 1 cash on cash returns, and then we get into some of the specifics like what is the purchase price per square foot, loan to value, debt service coverage ratios, and my graph out down here are cap rate for each property versus the year 1 cash on cash return. Coming down to the second, we're coming in and looking at the sales proceeds. So in the cash flow of the property. So we look at, okay, over 5 years, in the 5th year, here's my cash flow on Summit. Here's my cash flow on Plaza. We're just giving that 1-year cash flow. Again, you can run the other report that has the full 5-year cash flow analysis on each of the properties, but this is a comparison report. We want to compare these side by side. Then down here at the bottom, we've got our sales price. What am I going to be able to sell Plaza for at the end and Summit for, I should say Summit and Plaza in 5 years? and then what would be my proceeds when I sell those properties. Then we do our investment comparison. So I can come in now, I can look at my LTVs, my debt service coverage ratios, my cash on cash returns, and now my unleveraged IRR on the property and my leveraged equity IRR, equity yield or IRR on the property, and then we graph those out. I think this graph speaks 1,000 words. In the CCIM 101, we've got spreadsheets we're doing like crazy, but no graphs. So as a student, you're sitting there going, well, which one's better? Which one's better? I think you can just take a look at this graph pretty quickly and say, that Plaza, it's got a 14.47 versus Summit over here has got an 11.91. You can make a decision now pretty quickly. Now let me flip over and I'm going to select the portfolio report now. The portfolio report gives me some options. I can actually come in now and say, hey, I want that equity multiple page. If I want to have my impact of leverage, I want my impact of leverage page. Because what we're doing is we're combining and blending the cash flow on these now. I'll say I want my cash on cash return each year graphed out. And I'll click on generate report for that one. Raina, let's go back to questions. This one's going to take about 30, 40 seconds to complete. So hit me up with your best shot.
All right. I had, what are your thoughts on historical hold analysis? Say first year, third year, heavy COVID vacancy, then 5-year corrected projections.
Yeah. So obviously in the lending world, we would do what's called a T12, a trailing 12. I personally love to go back and see historical, and you could do that in the analyst. You can just change your original start date, purchase date to 3 years ago if you want to, and then use kind of what the rents were then, go in and escalate those rents to where they would be today, show any vacancies you've had in the past. Here's why I like seeing the trailing, at least the trailing 12. I have to look at that so I can do an accurate projection going forward. So we would do this every day, all day long in lending world, just to make sure that the projections, we want to get as accurate as we could on our projections going forward. I believe, so the 5-year projections, Thor, you're talking about there, obviously that's where your investment decision is going to come. And I'll just say, broker performers. I get broker performers all the time, and they go into the trash can. I love to see those historicals so that I can build my projections going forward off real numbers, not off a broker performer. No offense, my broker friends out there, but I'm sure you've come up the same situation where the accuracy of broker performance is not there. So any other questions, Raina?
What if the acquisition includes some development or extensive rehab costs? Is there a development module included?
Yeah, so we do have, this question comes up. We have in the input section the ability to put capital expenditures on any given year. So if you had a certain amount of capital expenditures in the first year for renovation, those types of things, you could put those in there. If you were going to include those renovations, those capital expenditures in your loan, I would add it to the purchase price. We don't separate them out, so we don't actually have something in the purchase price that can separate them. The only time you could do that is in the capital expenditure section, and that would be under the expense category. Let me jump into this report, and I'll come back and answer some more questions, Raina. But I want to kind of show, and let me make this bigger again if I can, show how we're doing this. So basically what we're doing is saying, okay, we're purchasing Summit 4.6, Plaza 3.75, the combined total, acquisition costs combined, loan combined, what's my total equity investment? So now we calculate that total equity investment. Then we start looking at the debt service and the debt service coverage ratios at time of acquisition for a blended DSCR on that. Lenders will like to see that. In fact, a lot of lenders are doing portfolio modeling right now to make sure the entire portfolio is cash flowing, even if you're only financing one property or financing a new property. And then we do that blended cap rate too on the acquisition side. So we knew Summit had a 5.73, and then Plaza had a 7. We'll blend it together, and it's not averaged. It's based on the overall acquisition and year one cash flow. All right, coming down. Let's get into the crux of it. The income on the property. So we break down the income on Summit. We break down the income on Plaza, again, over the 5-year period. We total them together for a combined NOI. And again, you can do this up to 10 properties. For the demo purposes, I just wanted to use these two. Subtract out our annual debt service. By the way, this is where our capital expenditures would be separated out if we had those capital expenditures. Gives us our cash flow before tax for our portfolio each year. Then we're going to look at the sales proceeds at the end of year 5, selling Summit Apartments. This was our sales proceeds. Selling Plaza. This is our sales proceeds for combined sales proceeds of $3.5 million. Now that we have all that, we can now do our investment measures. So now we can calculate what's our cash on cash return, what's our return on our equity, what is the unleveraged IRR on the portfolio, and then what is the before tax equity yield or IRR on that portfolio over that 5-year period. And last line, I added the equity multiple for now the portfolio, showing that if I owned these for five years, I would have a 1.76 equity multiple, multiplying my money 176% there. We do CCIM T-bars here on the unleveraged, the financing, and our equity cash flow. That would be the cash flow going in and out of my pocket. And then I clicked on some of those KPIs, including the annual cash on cash return. So this is basic. I call it a dividend return because a cash on cash is equivalent to a dividend. So you can see these dividends down here at the bottom, side by side. My equity multiple, that's again for the portfolio. I love graphs. I love pretty images. I love visuals. And then our impact to leverage analysis. Again, if I paid cash for the Summit and Plaza, I'd have a 6.98% return. My blended cost of capital is 4.06, giving me a portfolio equity return of 13.05. And the way to look at this, that's assuming I sell it in the 5th year. I would have a 13.05 each year, 13.05% return each year for that 5-year period. Versus, let's say I sold it in the 3rd year. Well, my property hasn't appreciated enough quite yet, so I only have an 8.5% IRR, but that would be for years 1, 2, and 3, 8.5%. So this can help make your decision on when to sell that property as well. Now, once I built this report, I got a 7-page report. Now I can email it, I can save it, I can print it. It's a PDF, so it's easily shareable as well. All right, Raina, any other questions?
Okay.
Now, that's the comparison of the portfolio. Like I said, once you have the properties in there, super easy to come back and run the report. You may want to say, okay, I ran a comparison report with 10 properties for this client. They came back and they said, I don't want these 4. So you could come back, uncheck those 4, rerun it again, say, okay, let's narrow this down. Let's narrow this down. Let's narrow that down. So these are different things that you can do. All right, Raina, sorry.
It's okay. It's okay. Can you do an optimal holding period for example, it would be better to sell in 7 years versus 5?
Yes. On the comparison report, we have an optimal holding period over here, and it will tell you for each property that you're comparing when is the optimal time to sell each individual property under that. And it will do the cash flow analysis on that optimal holding period. On the portfolio report, you can do an optimal holding period here by IRR as well as NPV. And that would be for the portfolio, not for each individual property.
And is the comparison, are these reports also exportable into PowerPoint?
These are exportable. They're in PDF, but they don't go into a PowerPoint. Unless you build a commercial package with it. If you built the commercial package with it, you could put it into a PowerPoint. But typically what I do is I'll put it into a PowerPoint with screenshots. And so I'll take the graphs and I'll take the PDF and I'll have that PDF report ready to go kind of when I'm making my presentation. But then I'll use Snagit. I love Snagit. And I'll take screenshots of, let's say, some of those graphs and put it into my PowerPoint presentation. But just kind of going back to the whole offering memorandum, you can make a flip book offering memorandum, something like this. And I can make, actually Summit Apartments, I found out is now called Tuscana Luxury Apartments out in Gainesville, Florida. I found it and pulled it up and was able to go get a bunch of pictures of it and actually build a full offering memorandum on that Summit apartment complex, which is now known as Texana Apartments. So I thought that was pretty cool because I've been dealing with Summit and teaching CCIM finance or CCIM courses for so many years. And I was able to drill down on the actual, here you kind of see the cash flow analysis that we put in to the full offering memorandum. And then we actually go into putting demographics and infographics in here. So this is the flip book version, but we also we put on the website. You can make an email campaign out of this. So once you have those numbers in there, you don't even need the numbers. You can build these pretty packages. This is a PDF version of that. What do I mean by a commercial package? This commercial package is what we would also call an OM, offering memorandum. And so our system does those incredibly well, incredibly quick, and incredibly easy as well. All right, Raina, questions?
Okay, and if you've answered these, Todd, I apologize. I was trying to kind of catch them as they were coming in. Does the account for historical cash flows or trend analysis or only current projected cash flows?
Okay,
does this account for? Sorry, does this account?
Yeah, so what we're doing, you go in, you start, typically year one, you'll start with the current cash flow of the property, what you're looking at the leases, right? So you're analyzing the leases, you're analyzing that rent roll, you're looking at this today, and then you'll go in and do a projection going forward 5 or 10 years. So this is what we do on Wall Street. This is what we did in financing. This is what people are using Argus for. So Argus, $5,000 for one license a year, and it's extremely painful to use. I used this thing for 14 years. I am not a fan of Argus. We built this very Argus-esque, but you saw how simple it was. So you're actually putting information out that is cleaner, prettier, and I'm going to say right on accuracy with Argus. I've got some institutional investors that use Argus. They'll use our system initially to get the property under contract to make the decision because they don't want to wait 6 days to get the Argus run in this particular market. They can't do that. And they'll come back to me and they'll say, Todd, we ran it in TheAnalyst. We went and ran it in Argus. It took us 6 days to run in Argus. It was 0.01 difference. And they just love it because, and that's, I mean, assumptions. You'll have change in assumptions all the time. In fact, I've had other people that say their Argus comes out in error because there's so many inputs, so many different things in Argus, 400 different categories in Argus. And they're like, I missed something. And they'll use the analyst to double check their Argus run. So I think that's kind of humorous.
Okay. When you purchase an asset, more than likely the new purchase price will be used by the appraisal district to reassess the property. Normally that leads to higher property taxes for the new owner. Is there a margin that needs to be added to the property taxes for the new owner?
Yeah, and this really depends on your state. So Texas is a non-disclosure state, so we don't reset taxes at the time of sale, unlike California, Florida, and some other states. So what my recommendation would be, if you're in one of those states that reset to the purchase price, you can go in the property tax section into the itemized expenses, and you can adjust those annually. Let me just kind of see if I can jump in there real quick and show you. So we didn't do itemized expenses on Summit or Plaza, but if I was to do those itemized expenses, and you can see how quickly I can jump around. I can jump to any of these sections by just clicking over here. But if I was to do those itemized expenses down here, I could go into my real estate taxes and I could say, okay, year one is going to be this much. We're going to increase it year two by this much, or I can put in a total dollar amount each year as well, so that you can make those adjustments. But it comes down to the millage rate. It comes down to your state and how they treat each of those individual taxes. Let me, I know some people got to jump. Let me just say, the Analyst Pro, we've got the investment, the lease analysis, we got demographics in here, we got flood maps, crime information, environmental information. We put all this together into what we call our Commercial Package Pro to create that entire package. That entire package then creates a PDF. We call it an OM Plus because it really becomes kind of a due diligence package if you want it to be. It builds a property website that we host for you. It creates that flip book that you can easily share out, and it creates a full email campaign for you as well. And it does it very, very quickly. I want to give a shout out to all of our subscribers that have been with us over the last 11 years. We're happy to do a demo. Raina and I can do demos for you all day, every day, all day long, right, Raina? No, Raina's got a calendar that you can set up a one-on-one demo with her. She can go through and show you how to create that cool offering memorandum commercial package. Our license fees are basically $600 a year per user, but we do have a discount for CCIM members. If you've attended this webinar and you are interested in TheAnalyst PRO, email us and we will give you a special pricing on that. You can email Raina or you can email our sales team and we'll let you know what the special rate would be for you. Thanks to being a CCIM member and attending this webinar as well. With that, Raina, let's go back to questions if we have any more.
Okay. Let's see. I don't know if you were able to talk about the customization on the commercial package pro. I know we touched on it briefly, but it says, can I import elements into my final reports and what degree of customization is available in the reporting layout?
Fantastic. That's a great question. Quickly on that, we have 8 different templates, including a landscape template that you can use for building that commercial package. Now it is template based. So, say, well, I would rather have this picture over here or down here as though it's there. You can go through the different templates, see if there's a template you like. The customization, all the accent colors, you may have seen some of the accent colors I had, would be your accent color. Obviously your logo, your contact information on there. And then we have the ability for you to add up to 9 additional documents or images in there as well. So you can add a PDF document, or maybe you have comps, CoStar comps you want to include in your offering memorandum, your package. You can take that PDF, add it to the commercial package. It goes on the table of contents. You can reorder it. It numbers it, all those great things. So customization, you can add your own additional sections, if you will. I call them attachments, but people get confused when I say attachments because it's included. It's included in the commercial package. But our templates are set, and that's why it's so simple to use. We don't want to get into, InDesign. That's actually what we're trying not to do, and having people, space out or resize pictures. No, this is drag and drop your pictures, throw in some description text, and you're off to the races in doing that. We pride ourselves on just being so simple, so fast, so easy. So we have our financial analysis, our modeling is right up there with Argus. I have people compare us more to Argus and Excel than anyone else. And then as far as the simplicity of creating that OM and commercial package, 10 minutes, you can have a full OM package, a full due diligence package. No one else out there is as easy or as comprehensive as we are. And then pricing wise, we're much less than anyone else out there. So.
It says you host the property website. Am I able to integrate this with my domain or SharePoint site?
Yeah, so you'll have a link to that site and you can embed that link or iframe in the property website we're hosting into your own site.